Hey everyone, welcome back to Corporate Decoder, the place where we break down SEC filings so you don't have to. And let me tell you, Zeta Global's latest report is a juicy one. It looks like they're trying to level up their game after a big acquisition and some interesting financial shifts. Before we dive deep, make sure you're subscribed for more of these straight to the point corporate breakdowns. We also have a fantastic community over on Discord, so join us there, the link is in the description below. Let's see if Zeta is truly cooking with gas or just burning cash. Alright, so this is Zeta Global Holdings Corp's quarterly report for the period ending June 30, 2025. It's basically a check-in on how the company is doing financially and strategically over the last 3 months and the first half of the year. First up, let's glance at their balance sheet as of June 30, 2025. They've got total assets of about $1.1 billion, which is slightly down from December 31, 2024. That's not a huge swing, but it tells us they're not massively expanding their asset base right now. On the flip side, their current liabilities are around $94 million, which is also a slight decrease from the end of last year. They owe money to suppliers and have accrued other expenses just like any business does. Now for the exciting part, stockholders' equity, which represents what the owners actually own. As of June 30, 2025, it's about $673 million. This includes their Class A and Class B common stock and a significant chunk from additional paid-in capital, which is basically the money investors paid for stock above its par value. They've managed to grow this, which is generally a good sign. Let's talk about the engine of the company, their revenues. For the 3 months ending June 30, 2025, they raked in an impressive $308 million. That's a substantial jump of over $80 million or 35% compared to the same period last year. This growth is a big deal and they attribute it to new customers as well as existing ones spending more. But of course a company has to spend money to make money. Their cost of revenues jumped by merely $26 million or about 28%. This is mostly due to higher marketing and media costs, which makes sense if they're bringing in more revenue. General and administrative expenses also went up by about $11 million or 21.5%. They say this is due to more employee costs and professional services, which is a bit concerning, but also expected as the company grows and integrates acquisitions. Selling and marketing costs climbed by close to $11 million or 14.3%. Again, this is tied to more employees and marketing efforts, a common strategy to drive more revenue. And R&D, the lifeblood of any tech company, saw an increase of almost $7 million or 29.6%. This is crucial for staying competitive. Depreciation and amortization also increased by over $4 million. This usually means they're investing in more long-term assets or have acquired new ones that are being accounted for over time. Despite the revenue surge, they actually reported a loss from operations for the quarter at around $5 million, down from a larger loss of about $26.6 million in the prior year's quarter. So while revenues are up, the operational expenses are eating into profits. Interest expense actually dropped significantly by about $2.4 million. This is good news as it means they're paying less on their debt. But then we look at other expenses which went up by a large amount, basically from about negative $1.6 million in income to positive $6.4 million in expenses. This seems to be driven by changes in the value of their acquisition-related liabilities. Essentially, things they owe related to past company purchases are now costing them more. All of this led to a net loss of about $12.8 million for the quarter. While better than the $28 million loss last year, it's still a loss and shows the challenges of growing this fast. Now let's look at the first 6 months of the year combined. Revenues are up a massive $150 million or 35.5%. That's a really strong performance in revenue. Cost of revenues also increased by about $52.5 million or 31.3%. This aligns with the revenue growth, again showing that the costs are following the top line. G&A expenses went up by $16 million or 16.2%. Selling and marketing expenses increased by $14.7 million or 10%. And R&D saw a substantial jump of $13.8 million or 31.6%. Interestingly, they incurred about $3.2 million in restructuring expenses this year, which wasn't there last year. This could be due to integrating acquisitions or streamlining operations costs that are often one-off but can impact profitability. And their net loss for the first half of the year was about $34.4 million. This is an improvement from the $67.6 million loss last year. So the trend is definitely towards reducing losses, but they're not profitable on a GAAP, generally accepted accounting principles basis yet. Now, companies often talk about adjusted EBITDA to show a rosier picture. For the quarter, adjusted EBITDA was $58 million last year. This metric strips out those non-cash expenses like stock-based compensation and also things like restructuring and changes in acquisition liabilities. It shows their core business operations are generating more cash. Their adjusted EBITDA margin is about 19.1% for the quarter, up from 16.9% last year. This means for every dollar of revenue, they're generating more profit from their core operations, which is a good sign of improving efficiency even with the higher expenses. Looking at cash flows for operating activities, they generated about $76.8 million in the first half of 2025. This is up from $55.8 million in the same period last year, showing a healthy increase in cash generated from their main businesses. However, they used about $61.4 million for financing activities, mainly due to repurchasing their own stock and paying for acquisition-related liabilities. This shows they are actively managing their capital structure. They've got a substantial credit facility of $550 million, which they are using for general corporate purposes, acquisitions, and refinancing debt. This gives them financial flexibility. They currently have about $196.7 million in outstanding borrowings on this facility. As of June 30, 2025, they have a significant number of unvested restricted stocks, RSUs, and options totaling over 35 million shares. This is important because it represents potential future dilution for shareholders as these vest and are exercised. Now let's look at the risks. They're highlighting risks associated with their technology and development work in India. This includes potential difficulties in hiring and retaining talent, wage inflation, and managing intellectual property rights. This is a common strategy for tech companies to save costs, but it comes with its own set of challenges and potential disputes over platform operations. This could impact their cash flow and financial results. They also have a stock repurchase program where they authorized up to $100 million. This can be used to buy back their own stock, which can boost shareholder value, and also for withholding shares to cover taxes on employee stock awards. They've been actively repurchasing shares in this quarter, using almost 2.7 million shares. So what's the story here? Zeta Global is definitely in a growth phase, fueled by acquisitions and increased customer spending. They're showing strong revenue growth and improving operational cash generation. However, their expenses are also rising significantly, which means they're still facing operational losses on paper. The company is navigating a complex environment with global economic uncertainties and the inherent challenges of managing international operations and technology development. The key for investors will be to watch if this revenue growth translates into actual profitability and if they can effectively manage their cost structure, especially with ongoing integration of recent acquisitions like LiveIntent. Their substantial stock-based compensation also needs careful monitoring as it's a significant operational cost. Alright, that's our take on Zeta Global's latest filing. What do you think? Are they on the right track to profitability, or is the growth coming at too high a cost? Let me know your thoughts in the comments below. If you found this breakdown helpful, give this video a thumbs up and make sure you subscribe for more corporate analysis. And hey, don't forget to join our Discord community linked in the description. We're building a great group to discuss these topics. Thanks for watching, and we'll see you in the next one.